Today on Go Ahead Ask, it's easy to buy investment in real estate. The tough part is deciding when to sell significantly appreciated investment property. Should you sell? When should you sell? What are your options if you do sell? Let's unravel that mystery today on Go Ahead and Ask.
Building wealth in real estate? Let the Exeter Group take the mystery out of how it's done on Go Ahead Ask.
Welcome to Go Ahead Ask by the Exeter Group, where we unravel the mystery of investment real estate. Our objective is to provide investors with better quality educational information so that you can make better informed investment decisions. I'm Bill Exeter, Chief Executive Officer of Exeter 1031 Exchange Services, and your host for today. The Exeter Group of companies includes Exeter 1031 Exchange Services, that serves as a qualified intermediary for 1031 exchange transactions. We handle all types of exchanges in all 50 states. The Exeter Group also includes Exeter Trust Company, that serves as custodian for self-directed IRAs and individual 401ks, as escrow agent for specialty holding escrows, and as trustee for title holding trust or land trusts. Here at Go Ahead Ask, we always encourage questions or topics. So please send your questions, topics, or even if you want to appear on Go Ahead Ask to ask@exeterco.com or call us at area code 619-239-3091. And if you like or love Go Ahead Ask, like it, subscribe to it, share it, and comment on it. We will respond to all comments. Today's podcast is entitled Unraveling the Mystery of Exit Strategies for Highly Appreciated Real Estate. Like I said at the beginning, it's easy to buy investment real estate. The tough part is deciding when to sell significantly appreciated real estate. Should you sell? When should you sell? What are your options if you do sell? Should you just sell and pay your taxes? Or should you sell and structure a tax-deferred transaction of some type, such as a seller carryback note, a 1031 exchange, a 1033 exchange, a charitable trust, or perhaps a qualified opportunity zone? If you structure a tax-deferred exchange, should you reinvest in active real estate or passive real estate? And what type of real estate would be suitable for you? We're going to unravel that mystery today on Go Ahead Ask. Today, we're really excited to have not just one, but two guests that have significant experience in helping investors navigate through these difficult financial and investment decisions. Our first guest is Aubrey Morrow, who's a certified financial planner, a registered investment advisor representative, and fiduciary, and we'll cover that in a minute. He's also the host of the Financial Advisors radio series on AM 600 KOGO, on Saturday mornings at 8 o'clock a.m. Pacific time. And he's president of Financial Designs Limited, a fee-based financial planning firm. He has expertise in investment planning, tax strategies, and advanced estate planning. And you can find out more about Aubrey on his website at www.moneytalkradio.com. And our second guest is Doug Tabor, who is a CCIM. More on that in a minute as well. He's also a rental housing realtor with Keller Williams Realty and KW Commercial. And his website address is www.rentalpropertybroker.com. Aubrey and Doug, welcome to the show.
Thank you, Bill. Good to have you.
Thanks, Bill. Happy to be here.
Fabulous. And Aubrey, let's start with the last part of your introduction was a fiduciary. Can you give us a little more detail on that and why that's so important?
Bill, I think the best definition of a fiduciary is one where the advisor only acts on behalf of the client, not necessarily the broker's position or the broker's company. So you have to be a fiduciary acting on behalf of what is the best interest of the client you're working with.
Good point. And I think it's critical. It really helps put the client's interest first instead of focusing on commission like a lot of the stockbrokers and what have you do. And Doug, when I introduced you, mentioned CCIM. Tell us a little more about that. That's such a critical designation as well.
You know, it really has been, Bill. CCIM stands for Certified Commercial Investment Member. And it is a designation that the National Association of Realtors provides. It's a series of coursework that allows, your real estate agent like myself to really learn more about how to serve investors through additional increased information on taxes, finance, how to come up with rates of return. Really helpful, especially since I focus on working primarily with rental property owners. It's been very, very helpful.
Excellent. That's such a critical designation too, that puts you kind of above the competition, so to speak. Now let's delve into unraveling the mystery of exit strategies for highly appreciated real estate. Investors that own highly appreciated real estate today, they're often confused about what they should do. Should they hold? Should they sell? Should they do a tax deferred strategy? So, I thought the first thing we probably should do is define what happens if you just sell. So, Aubrey, you want to kind of cover what happens if the investor just decides to sell and not do anything else?
Well, first of all, I think, Bill, the biggest surprise is going to be whenever they find what their tax liability is going to be. So many people in this incredibly booming real estate market are excited about being able to sell their property and have the really substantial, nice rates of return. They respond to their realtor, be it residential or commercial. They get the explanation of what they could sell the property for. They go, my goodness, I'm going to have this kind of profit. Let's do it. They list the property, and in Southern California, they're selling like hotcakes, and Doug Tabor will attest. Then all of a sudden, people are happy. They get a big check, and unfortunately, it's sort of good news and bad news. The good news is you got a really nice check. You sold your property at substantial appreciation, a lot of profit. The bad news is around April the 15th, whenever they sat down with their accountant, and they said, I what? So if you take a look at what people paid for their property, it's called basis. Whatever they originally paid for their property is called basis. Any improvements they made on their property is called adjusted basis. And then, Bill and listeners, whenever they sell the property, the difference in their adjusted basis and what they sell it for is called gains, called profit. And Uncle Sam will get substantial amounts of that. Could be as high as 20% federal. In California, could be as high as 13.3%. There's a thing called recapture of all the depreciation they've taken over the years. And now we still have this thing called Obama tax, which is 3.8. Forgive me, that's a bunch of numbers, but the bottom line, whatever your gain is, you could lose anywhere from 35 to 45% of your profit unless you do some planning strategies. And it's exactly what I think we're going to be talking about today. So good news, nice appreciation. Bad news, 30 to 40% of that is going to be going to Uncle Sam and the state coffers in the taxes on your appreciation on your property. And certainly there's a lot of other options that people should consider. And it's exactly, Bill, what this is all about today, hopefully.
And certainly, as a lot of folks have said recently, it's a seller's market. So the good news is it's a seller's market. The bad news is it's a seller's market. Once let's just assume and hope that the investor sits down with their accountant before they sell. Otherwise, they really get a nasty surprise. So assuming they've actually sat down with the accountant and gone through the calculations to compute exactly how much tax they're going to incur by the selling of that property, then we can look at some strategies. And you went through the numbers. That's a big hit. And that means that the investor is going to have to write a check for that 35, 40%. That means a huge chunk of their equity is going to the federal and state government. Makes it very difficult to do anything else with that. So then they got to sit down and really think about, well, what am I going to do to avoid that perhaps? Of course, one option is if you like the property, if it's producing the cash flow you want, if it isn't broke, don't fix it. So perhaps you just hold the real estate. In today's market, like Aubrey said, it's a phenomenal market, highly appreciated assets. So in a lot of cases, now's the time to take advantage of that sale. But then what do we do with it? One option would be to sell the property and do a seller carryback note. Folks that are trying to sell, get out of real estate, but don't want to get hit with the taxes, or at least get hit all in the same year with the taxes, could look at a seller carryback note. Generally, the cash you get in the year of sale, so if they put 10% or 20% or 30% down on the property, would be taxable that year. And then the rest of it is deferred over the term of that seller carryback note. The good news is at least you spread that tax over a number of years, maybe 5 or 10 or 15 or 20 years. So it hopefully gets taxed at a lower tax bracket. The bad news is you sold the property and you've triggered your gains. So whether you want to or not, you're going to be deferring that tax and paying that tax over a period of time. So that's when the investors may look at other strategies that can help them defer the taxes indefinitely. So one, of course, that's near and dear to our heart is the 1031 Tax Deferred Exchange, where you can sell an asset, do a 1031 exchange, defer the federal and the state taxes into the new replacement property that you invest in. So you can continually defer the tax over and over. And we're not going to get into a whole lot of details in the 1031 exchange since we have a lot of podcasts in our portfolio that discuss 1031 exchanges, but that's one of the options. So I thought we'd maybe talk about kind of the possibilities that investors can invest in, the replacement property solutions or options. And the first one is, Aubrey, you want to talk about the terrible T's as to help, that kind of sets the stage for active versus passive.
Bill, it's really been interesting because I own rental properties, and certainly a lot of people watching us today actually own rental properties. And most of the people that own properties for a long period of time bought their property when their hair was black. And now it's been many, many years later, their hair is now gray. And over that period of time, Bill, as you said, they put up with the terrible T's. And certainly we have been over the years writing down different T's, different T's, different T's. And the list that I can recall right offhand is the terrible T's consider is tenants, toilets, trash, turnover, teenagers, telephone calls, taxes, termites, and toddlers. Those are the terrible T's. The good news is you put up with those terrible T's over the years, and then, Bill, you can make some decisions we'll talk about today of selling that property, doing some sort of an exchange, and having what we call some terrific T's. And Doug will explain some of those terrific T's have to do with more time with the kids and the grandkids, and certainly T's are a little bit better today with a thing called travel. So we're going to trade the terrible T's to some terrific T's and really harvest what I call our real estate garden while we are able to enjoy the rest of our life with our kids and our grandkids. So getting rid of those terrible T's, trading for some terrific T's, and enjoying our life, and again, harvesting the garden of our real estate that we've been planning for many, many years.
And certainly now that we're almost completely out of COVID and we're starting to get back to normal, now some of those terrific T's can actually become a reality, such as travel that you mentioned. And that also gives the investor a chance to kind of sit down and think about, their life, their lifestyle, what's important to them, and how do they get some of that time back in their life. And that's where they look at kind of active versus passive real estate investments. And Doug, I'm going to throw this one to you. You want to talk about kind of what the passive versus active strategies might be, and then we'll dive into it a lot more deeper.
Sure, Bill. I want to back up a little bit because Aubrey always forgets the story about one of our clients that came through one of our webinars, and she had a problem with one of her tenants who was parking illegally a trailer in front of her rental property, which drove her nuts because it used to be her family home and now it's a rental. And that we added that to the list of terrible T's, illegally parked trailers. And, that was a success story. And in that situation, we were able to help the client through a 1031 exchange get into another investment property. She, in fact, decided to go into another more active role. She purchased a condo. She downsized from that single family residence and bought a condo, which was close to another condo she had in Little Italy in San Diego. But some owners are tired of dealing with all the activities of property management, especially today. We're dealing in a situation, especially coming out of COVID, where there is a lot of political activity. There's a lot of new legislation that's coming down. It's really making it difficult for the independent rental property owner to manage their rental properties effectively and efficiently. Some haven't even received an income from their properties in over a year. There's just a bunch of those stories out there. So quite frankly, the active management is not as desirable, where they're having to deal with the tenants, having to deal with the new laws that are coming out. And a lot of folks that are coming through our webinars are really focused more on the passive side. And that's where they're taking their equity and maybe relocating out of the state of California many times, or into a state that's more easy to deal with, but also into an asset class that's more passive, maybe a single tenant triple net where they're investing in a Taco Bell, or they're investing in some sort of quick service restaurant or an auto zone where you're leasing that building to a corporation. They're a nationwide corporation, and they're taking care of all of the taxes, all of the insurance, all of the maintenance of the property. And essentially, you just receive a check and get a nice little return on that. You're just the landlord of that building. Aubrey will probably talk about a Delaware Statutory Trust, which is another fantastic option for owners that are looking to get out of the active side of management. And that's where you're able to, with other investors, invest in a big institutional property. You know, it opens up those industrial centers and those Amazon centers and big 1,500 unit apartment buildings. So that's really the big question. You know, it's really easy to sell a property right now. Aubrey touched on that. You've touched on that. We're an incredible seller's market. Making that decision on where to go from that sale is the hard part. And really the first step after meeting with your CPA is, like you said, Bill, active or passive. Do I want to continue to deal with the terrible T's, or do I want to go into something that I don't have to really worry about as much and enjoy those terrific T's like the time and tranquility?
And so you're absolutely right. Certainly some investors love the control and love the active and management process, and others just want to get rid of that. So obviously it depends on what their goals and objectives are. And you had made a comment too about, you know, legislative initiatives and things like that. And then of course we have the Biden proposal with all sorts of potential tax policy changes. And he's obviously hinting and probably going to spend quite a bit of money on infrastructure. And anytime they do something like that, you're probably going to have some eminent domain action where the government takes the private investor's property for the quote unquote public good. So we probably should talk quickly about a 1033 exchange transaction, very similar to the 1031 exchange, but I just wanted to throw it out there so people are familiar with that. This is what we call an involuntary conversion, where the government tells you, I'm taking your property, and they give you a check for it. A lot of cases right off the bat, the investors, it's scary. It's just frustrating because you didn't want to lose the property and it's being taken from you. But there's some great planning options here as well. So just kind of put that bee in your bonnet, so to speak, that if you are either losing your property to the government, or perhaps you're selling your property and you're negotiating with a government agency that has eminent domain authority, you may want to ask the government to threaten you with eminent domain action. If you can prove that they effectively have said, I'm buying your property, but if you fail to close, if you fail to sell, you fail to convey the property to us, we are going to take your property. Then you qualify for the 1033 exchange. And that gives you anywhere from 2 to 5 years, depending on what subsection of the code you fall under, to reinvest in whatever like-kind property you need to satisfy the requirements. So that's something you want to look at if you're either having the property taken from you or you're negotiating to sell it to a government agency. And with that, we're going to take a quick commercial break for a message from our sponsor. This episode is sponsored by our sister company, Exeter Trust Company. Did you know that all individual retirement accounts are self-directed IRAs? It's because you choose where to put them. You choose whether to put your self-directed IRA at a bank or at a securities or brokerage firm or a life insurance company. So that makes it self-directed. But did you also know that all IRA custodians are not created equal? Most IRA custodians, like the banks, the securities firms, and the life insurance companies, limit you to publicly traded investments such as stocks and bonds and mutual funds. But some IRA custodians, like Exeter Trust Company, allow investors to invest their IRA funds in other alternative assets such as real estate. Investors can acquire real estate, mortgages, deeds of trust, or tax lien certificates inside the IRA as an investment inside the IRA. To learn more, call Exeter Trust Company at area code 307-222-8750, or visit them on the internet at exetertrustcompany.net. And we're back. We're talking about unraveling the mystery of exit strategies for highly appreciated investment real estate. And we've been talking about some of the options in terms of 1031 exchanges and 1033 exchanges. We've talked about the wonderful, terrible T's and the terrific T's and the active versus passive. So now we're going to get into some actual replacement property solutions and strategies. The one thing I wanted to mention is, right now we're in a very hot market, as Aubrey and Doug have both said. It's a seller's market, absolutely. And so clients are saying, well, how do I deal with that? So from a 1031 and 1033 perspective, if you could delay the closing of your sale transaction, it buys you more time to find replacement property. So perhaps as a seller, you're in the driver's seat today. When you're listing the property, you can put the buyers on notice that you're doing a 1031 or 1033 exchange, and you need them to cooperate with your 1031 exchange. That might be going into contract with a long-term close or options to extend the closing. Perhaps if they need access to it, you might be able to lease it to them with an option to buy. So really anything you could do to tie up the property with the buyer, give them the comfort zone, a comfort level that you're going to close on that and sell them the property, but you need more time to find your replacement property. That helps you. It gives you more time to look for replacement property. On the flip side, if you're looking for replacement property, you can always look for that sooner. Now, you're not the seller in this case, you're the buyer, so you're not in the driver's seat. Sellers today are not very cooperative, so that's one of the challenges we have. But certainly if you can find a seller who is cooperative, if you can get a long-term close or options to extend, things like that, it could work. Perhaps you offer to lease the property and pay fair market rent for a month, 2 months, 3 months, whatever, with an option to buy. Just throwing some ideas out there on how to work with the buyers and sellers and see if you can get all the timing to line up. Once you get into that, then we get to that question as to what are you going to buy? So one of the options that is more on the passive side is net lease properties. And Doug, why don't you give the listeners kind of a rundown as to what a net lease property is, some examples, and why investors might want to consider that?
Certainly, Bill. Single tenant, triple net lease properties are fairly popular, especially from folks that have owned apartment buildings, small rental properties, because of the aspect that they are very passive. Now, the term single tenant, triple net, what does that mean? Well, single tenant generally means that you're buying a property or a building that's a retail space with just one tenant in it. So we're not talking strip malls generally. Now, you can purchase strip malls that are net lease properties, but for the most part, we're talking about that single tenant, triple net property. And think about when you're driving down the road, you see a Pizza Hut in a standalone building, or you see an AutoZone or a Taco Bell, fast food restaurants, a Chase Bank. Those are all examples of single tenant, triple net buildings. It's a standalone building. It has a big corporate tenant in it. It doesn't have Bob's Pizza down the road. It's not a local community tenant. It's a big corporate tenant. It's Pizza Hut. It's Domino's. And the reason they call them triple net is when you do the numbers on these properties, once you receive your income, all of your income is going to be net of, first of all, taxes. So the tenant is, as part of the lease, is generally responsible for any property taxes. The second net of the triple net is insurance. The tenant is generally responsible for providing their own insurance coverage. And then third, maintenance. You're not going to be required to go over and fix the McDonald's building that you own. McDonald's has a full staff of maintenance people that handle that. They want it done their way. Pardon the pun. So single tenant triple nets are really popular in the fact that they're very passive.
In the same category of passive investments, we have the Delaware Statutory Trust that Doug alluded to. And Aubrey, you want to give everyone kind of an idea of what is a Delaware Statutory Trust? How does it work? And why would somebody want to invest in one?
Sure. As we get a little older, typically our interest is no longer managing properties, getting those terrible T's that we've talked about. Generally, when people think about selling a property, they have about three choices. One, sell the property and pay the tax. And typically that is the least option they want to consider because of the terrible loss of their acquisition and the appreciation in taxes. Bill, as you just mentioned, they typically go two routes. One is an active owner, as Doug just mentioned. They continue owning a property, continue managing the property, and people like being an active owner. That's what it's all about. They stay in control. Some people say, I'm just tired of those terrible T's. I still want to own property. I don't want to pay the tax, so I want to be a passive owner. And very simply, a lot of the people that go to Walmart, for example, my wife and I are planting flowers, by the way, and she just bought a whole bunch of stuff from Home Depot, by the way. Guess what I get to do this weekend? Uh, Home Depot, certainly storage, large apartment properties. If you take a look at driving around the city, you'll see a Home Depot, you'll see a Walmart, you'll see an Amazon fulfillment center, for example. Those typically are owned by very large commercial real estate sponsors that buy the property, get their financing in place, and sell pieces of that particular property to passive owners via a Delaware statutory trust. So the main difference I've seen is that you give up control. So what's the negative of going to a DST, a Delaware statutory trust? You give up control. Some people say, I want to stay in control. I like being an active owner. And we say, well, this is not for you. A lot of people say, hallelujah. You mean I can still own property? I can still get projected passive income. I still get the appreciation, and I can do that and have no property management. Where do I sign? So the IRS Procedure 2002 came out literally some 19 years ago that allowed people to be a passive owner. And again, a large apartment property. Typically, we like Texas, Louisiana, the East Coast. California, Bill, as Doug and you and I know, this is a seller's market. The bottom line, people are selling properties generally above their fair market value because of supply and demand. You have a lot of people wanting your property. You're most likely going to sell your property for more than actually the property is worth. So why people are doing it? First of all, they're buying property because it's a big demand, it's a little supply, and extraordinarily low interest rates. So people are literally buying a property based on what their mortgage is. So it is an incredible seller's market. Well, if it's a seller's market and you do a 1031 exchange, you better not be buying in a seller's market. Duh, that doesn't make sense. So California is a seller's market. I think we'll all agree to that. The question is, where are buyers markets? Again, our DST properties, we like Texas, we like Louisiana, and quite frankly, the Carolinas have been some great places to buy. So our company monitors around 20 major real estate companies that buy properties, they get their own financing in place, and they break those properties up to pieces called a DST, where you can invest and be a passive owner for as little as $100,000. You'll take $1 million and own typically interest in 5 or 6 different properties, and you may have $1 million of income, around 4.5% to 5% thereabouts, typically tax sheltered, because the $1 million buys $2 million worth of property. That makes your cash flow generally tax sheltered, and you have appreciation and tax benefits on the $2 million. So Bill, this has really been a boom. It's a milestone. I've been in this business some 40 plus years. I own rental properties. Also, as a disclosure on this podcast, I own interest in 17 DST types of properties personally. So I happen to favor that. If your hair is gray, you still want to own property, you want to have those checks automatically in your checking account every month, you get a 1099 or K1 to your CPA once a year. And it's really been wonderful being a positive owner of real estate without the hassles of those terrible T's that we just addressed.
As you're talking, I'm realizing I don't think my hair is dark and I don't think it's gray, but it's kind of missing. I don't know what that says about me, but well, certainly from a 1031 and 1033 perspective, what we've seen with net lease properties in Delaware statutory trust is a great way to get out of real estate in terms of the active management role, and they get into passive ownership. And the DST can be a great strategy for a number of different reasons for 1031 exchange purposes. Some folks use it as a primary investment strategy. That's going to be what they identify. That's what they acquire as a replacement property. Other folks might use it as a backup strategy, that they're going to go out and find like multifamily property with Doug. And if they can't find it, or they do the due diligence and the property falls out, the DST is the backup. Or maybe they actually buy multifamily property through Doug and they've got a little bit of cash, 50, 75, $100,000 left over. It's a little difficult to do much with that, but they can put it in the DST and absorb that extra cash that normally would have been taxable. And then one of the things a lot of investors forget about is they'll sell property, go into a 1031 exchange, and then especially with coming out of COVID, if they're self-employed or retired or what have you, they may have a difficult time obtaining financing. And the DST has built-in financing that helps the investor solve that issue. So I don't know if you want to see if there's any other comments on that in terms of how it can kind of help investors.
One thing I will say, Bill, is that it's very stressful for a seller of an investment property to think about the time constraints with regards to the 1031 exchange. I was just speaking to a gentleman yesterday, and his concern was, how do I identify and go through that stress of that 45-day time period? And generally, these folks have owned these properties, as 5, 10, 15, 20 years. And so, jumping from the steady ownership of an investment property and then into that 45-day turmoil, it really kind of overwhelmed them. And I think that what my clients, many of the clients that we've worked with together, with you, with Aubrey, have said that they like most about the DST especially is that it's not as stressful to go through that transaction. Aubrey's team's great about presenting multiple options, very diverse options, and those options are there. So when we close escrow, that 45-day clock starts ticking. There's not that stress of, off to the races trying to identify a replacement property, especially in a seller's market in California, if that's not what they're looking to do, to try to go find a replacement property outside of the state, of course, with travel restrictions and, the challenges of travel. It just seems like the 45-day is not as stressed when you're going into a DST.
That is so true. It absolutely makes it much, much easier. The 45-day period is absolutely the most difficult part of the 1031 exchange, especially when you're in a seller's market like today. Any thoughts on the DSTs, Aubrey, that I missed?
Bill, one thing is a lot of people think, if you ask them, how much rents are you getting from your property? They'll mention how much their renter is writing a check for every month. And people think that's how much rent I'm getting. Not really. I'm a tax guy. I don't do tax returns. I read tax returns. So if any of our listeners right now, our watchers, whatever we are today, own property, my suggestion would be for them to take a look at their Schedule E as in echo. And hopefully my memory is serving me good this morning, because line 2 on Schedule E shows your gross rental income. Line 2, Schedule E, shows your gross rental income. And Schedule E has a column for 3 properties, by the way. Under that line 2 are 15 items of expenses. And people should remember this. Line 12 shows your mortgage interest deduction. Line 12 shows your mortgage interest deduction. Keep in mind that Schedule E is done for your accountant for tax purposes. I'm looking for cash flow. How much cash flow am I putting in my pocket? It's not what I make, it's how much am I keeping is the question. So line 2 shows your gross rental income. There's 15 items of expenses. And again, line 12 shows your mortgage interest deduction. I repeated that on purpose. If you have an actual mortgage on your property, you want to find out what is your monthly mortgage payment times 12. So you want to change that interest deduction to what is my principal and interest. So line 12 typically is a larger number if you have a mortgage. Got that? Let's go on down. Line 18 shows depreciation. Obviously, that's an accounting function, so we don't want to cross that out and not use line 18. Typically, if you can then re-add all your expenses, typically your expenses are a little bit larger because you have a mortgage on your property, you're paying principal and interest. So you want to re-add your expenses, number 1, subtract your expenses from your gross rental income, and folks, that's how much you're putting in your pocket on an annual basis. Then divide that number into what you think your equity is on your property. That will be some sort of a number. If you're getting around 4.5% to 5% net in your pocket, as a general rule, you have a good income property. Mostly, we're not seeing that. We're seeing people getting substantially less. Another thing on your Schedule E at the very bottom page of Schedule E Hopefully you have a bracket around that, because the three benefits of real estate is cash flow, tax benefits, and appreciation. If you have lost a lot of your depreciation, you may be having to pay taxable income on your rental property, which again further reduces the amount you're putting in your pocket. So if you look at this from a tax perspective, if you're able to do a 1031 exchange and trade all that equity into owning a diversified portfolio, 4 or 5 different properties, not one, but diversification, many times your cash flow will be dramatically higher, completely tax sheltered because of the mortgage interest deduction on property. And oh, by the way, the new mortgage you add, you're not responsible for that. It's called non-recourse. It's kind of the best of both worlds, in my opinion. Our company has done over almost 600 of these kinds of expenses, our 1031 exchanges in the last 19 years. It's really been wonderful. We get postcards from clients saying and enjoying our equity without having to deal with the terrible T's. So if you look at it from a cash flow perspective, many times a 1031 exchange going to a diversified portfolio of DST properties, which could include a Amazon fulfillment center, it could be a Walmart, it could be a Home Depot storage, but we actually favor multifamily properties, very large multifamily properties in Texas, again, Louisiana, and on the East Coast. It's really been very gratifying for us to be able to do this kinds of business and be able to get those postcards from people that are enjoying their terrific teas.
And you had mentioned something that I wanted to circle back on, which was, when you're going through the tax return, if you're paying taxes, there's no brackets at the bottom there. And I thought that's a good point. You've got clients who have owned real estate for years, decades. And if they pass the 27.5-year mark on residential property, they fully depreciated that asset. They're not getting the tax benefits from real estate anymore. And so a lot of folks that fall into that category will sell, do a 1031 exchange, and trade up in larger properties in order to create additional cost bases that can be depreciated. And the DST can certainly be a huge, huge tool for that.
Not only that, Bill, is one thing that I see on a daily basis, because we analyze the income and expenses of rental properties on a daily basis. I mean, that's all we do to try to figure out what a valuation is. And just like what Aubrey was saying, many owners just look at what their gross income is, and they don't really take into consideration, especially if they've owned the property for decades, they don't have a mortgage, they're fine just making these low rent incomes, but they don't take into consideration the expenses. Typically, a rule of thumb is, say, 38 to 42% of a rental property is going to have expenses of the income. So 38 to 42 is kind of what we use as a general rule of thumb if you want to just simplify things. But I've seen swings all the way from 25%, which means they're just not taking care of anything, not taking care of the property at all the way to 55%, where someone's paying 55% of their income to expenses. And especially if many of these properties that have been owned for many, many years, maybe decades, they have not kept up with increasing the rents, which I see very often. Believe it or not, the equity, what Aubrey was mentioning, the return on equity is incredible compared to even what they're getting on their gross income from rent. So very important exercise Aubrey presented there on how to figure out what you're truly getting for your income of your property, especially as costs start to rise. And now we're having to see deferred maintenance. Lumber's triple the cost. Trying to get a contractor is almost impossible. And these buildings are all old, and they're going to need some deferred maintenance. And that's going to, again, cost a lot as far as expenses.
Very true. And so we've been talking about passive investments. And then we still get clients who really say, look, I really, really, really want to get out of real estate. And I get the net lease properties and the Delaware Statutory Trust, but I still really want to get out of that. And so one of those options would be various forms of charitable trusts. And so Aubrey, maybe you can give the listeners kind of an overview of charitable trusts, how they work, why they would want to implement one of those.
Sure, Bill. Generally, we start thinking about a charitable trust where the clients, for example, have no heirs. We see a husband and wife that have virtually no kids, no grandkids, very, very distant relatives, and also they care about nonprofit organizations. So one strategy is to set up what's called a charitable remainder trust, a CRT. And very simply, this is a legal document where basically people will set up a charitable trust. It's like a living trust. Most of us have a revocable trust. We have things titled to our name as trustees of our revocable trust. There's another kind of trust called a charitable trust, a charitable remainder trust, where right now our kids may be the beneficiary of our living trust. In this case, a charitable remainder trust, a charity is the ultimate beneficiary of that particular document. In very simple terms, people first of all go to their account, their estate planning attorney. If it makes sense, the attorney sets up a charitable remainder trust. People then literally give away their property. Whoops, they give away their property from themselves to themselves as trustees of a charitable trust. The charitable trust is a separate tax ID number. People are able to get a monster income tax deduction. Schedule A, itemized deductions, line 18, a monster income tax deduction based on the fair market value of the property and some other tax issues. I won't get into too confused on it. People literally have given away their property from themselves to themselves as trustee of this trust. Number one, big, big income tax deduction. Typically, it's limited to 35% of their adjusted gross income, and they can use as much as they can that year and 5 more years of the quote tax deduction. That also allows them to sell stocks and bonds and not pay tax, or sell other real estate and use a tax deduction to offset the tax. Then also they can sell that property inside the charitable trust. They sell the property. There is no taxes due. 100% of the income is producing income for their life. Most of it's tax sheltered. So they're able to get income for their mom's life, dad's life, and when the second person has passed away, whatever's left in that trust goes to the charity they've named. It's also out of their estate. So there are a lot of different strategies people can consider. Typically, charitable trust is more attuned, if you will, to very large estates that want to minimize estate taxes one of these days, and also typically where people are individuals, don't really have any direct heirs.
Perfect. And then you kind of get into the category where folks really want to get out of real estate, but maybe not. And then they try to execute one of these tax deferred strategies, and for some reason it goes wrong. And that's where the relatively new qualified opportunity zone may kick in. I want to be careful here because, a lot of folks actually, let me back up. A lot of folks will call us and say, if I do a 1031 exchange or a 1033 exchange, I sell real estate or real estate's taken from me, can I buy a qualified opportunity zone as replacement property? And typically the answer is, in that case, is no, because what the qualified opportunity zone really is a fund that is set up to buy real estate located in a qualified opportunity zone. And so what you're exchanging into would be a partnership interest or membership interest in that fund, which doesn't qualify for 1031 or 1033 exchange treatment. But it could be a backup strategy for those. So typically when a client asks about that, we're kind of looking at, well, what are you selling if it's not real estate? If you're selling a business or stocks or bonds or mutual funds or something that's going to produce a taxable gain, then that may be an option. Last week we had a conversation with someone who's selling foreign property, and that particular country would not allow a 1031 exchange to be put in place. So we suggested you sell it, you trigger your gain, look at the qualified opportunity zone. And with that, all you have to reinvest is your taxable gain. Now that only defers the current gain until December 31st, 2026. After that, most of that gain is going to be recognized and taxed at that point in time. And then you hold it for another 5 years. And the real benefit of those is that the new investment, the gain on the new investment is tax-free. So there's pros and cons there. Really, in my opinion, it's not really great for real estate, because if you want to stay in real estate, you should be doing a 1031 or a 1033 and reinvesting in replacement property. And that allows you to keep deferring the tax over and over and over until you pass, and then you can leave the property to your heirs and get that step up in cost basis. Where the qualified opportunity zone really says you've sold it, you've reinvested, you've deferred the gain for about 5 years, and then it's triggered and taxable at that point. So not really the best of all worlds there. So that was kind of a quick overview on the various tax deferred solutions and some of the replacement property options. Any final comments from anybody on things we haven't covered that you think we should?
Bill, one of the comments I wanted to make that a lot of people that are retired that really like one of the benefits of the DST is inheritance planning. I literally have two clients right now. One client has three sons, and the sons really don't get along too well. And dad owns a couple of very large apartment properties, and one son would want to sell them immediately. The other two sons wants to keep the property. It really becomes a real terrible situation in terms of the dilemma mom and dad are facing on how do they handle this. In this case, the DST turned out to be a fabulous solution because once you can do the DST, it can also be divided by a third or two-thirds. So when mom and dad have passed away, one kid can keep their one-third of that DST portfolio, the other could sell. And so it really is a really wonderful situation. I have another client right now that has three daughters, very similar situation. The daughters are married, one are doing pretty well, the other's not doing so well. And so the game plan would be when mom and dad passed away, one wanted to sell, the other wanted to keep. So in terms of inheritance planning, the DST is a wonderful fluid structure to where it can be broken in to giving a percentage of third, a third, a third. They can keep their one third or sell their one third. So that's really been another thing. Another thing in terms of death taxes, we don't know where the Democrats and the Republicans are going to wind up. We have certainly a Democrat in the White House. We have a Democratic-controlled Congress, and we have sort of a split in the Senate right now. And there's a lot of battling going on right now. But Mr. Biden is after the deep pockets. Mr. Biden is after the people that own the largest amount of wealth that represents the smallest amount of voters, if you will. So another thing of the DST is it allows for not having 100% ownership of the property, but partial ownership, and potentially you could have a discount of 30 to 35% in terms of the valuation of the property because of the illiquidity of it. I don't get too much in the weeds, but the DST has really become a wonderful option. I know I own a bunch of them personally.
And Doug, final comments?
Yeah, you know what I would like to just circle back on is you mentioned it's very hard to figure out what you're going to do with your equity once you make that very important decision to now sell your rental property that you have in place. But it is very easy to sell it. You know, we are in a seller's market here in Southern California and San Diego and really across the country. If you go to any of the markets, if you go to Florida, if you go to Texas, if you go to Idaho, they're all sellers markets right now. So before you jump in and list that property, I'm sure you're getting, many of the listeners are getting calls daily from real estate agents like myself, trying to urge them to sell, but really caution, slow down, talk to your CPA about it. And then if you're considering a 1031 exchange, maybe you're on a fence about a 1031 exchange, I always recommend to my clients that they at least engage the services of a 1031 exchange accommodator, even if they don't plan to do an exchange, because many times what happens, Bill, and you probably know this because you hear this story at the 11th hour, is that once we get 3/4 of the way through the escrow and that estimated settlement statement comes around and they see how much gain they're going to have, how much equity they're going to have, and then they talk to their CPA and they find out how much that tax bill is going to be, suddenly a 1031 exchange that wasn't on the table becomes on the table and they decide that they want to proceed forward with one. So I always recommend to my clients, even if you're not considering a 1031 exchange, start the paperwork, get it going so that at that 11th hour of that escrow, you will not be jumping through hoops trying to find something. And as part of that, as you know, as our partnership together, I do offer clients kind of an incentive bonus to work with me. And, you know, my program, my slogan is, if you list with me, I'll pay your fee. And basically what that means is I'll cover the cost of that 1031 exchange, that forward 1031 exchange out of my commission. It's not lost on me that everybody knows a real estate agent, so it's just another incentive, but really it allows them to have that decision, because I say, look, even if you don't decide to go forward with the 1031 exchange, you've still engaged the services of Exeter. You have that option and you're not completely stressed out over that tax bill that could potentially be part of the end game for you.
That's a good point, because we have a lot of clients who will say, I'm not sure I want to reinvest. I don't know what to look for. I was just going to sell. It's like, well, but what if within the 45 days after you sell, you think about something or find something you would want to invest in? So certainly setting up the 1031 exchange is kind of like an insurance policy, and there's no penalty if the 1031 exchange fails. You just pay the tax as if it was a regular sale.
And Bill, one comment is that a lot of people that own property for a long period of time, as they sit down with their CPA, the CPA says, oh, by the way, you've lost one of the three benefits of owning your property. One, you have great appreciation. You have nice income, but you're now having to pay income taxes, Bill, as you mentioned, because they've owned the property for a long period of time. A lot of people just don't know what their choices are. Generally, professional realtors, both residential and commercial, are interested in listing the property and selling the property because that's their job. That's what they do. I'd like to give a plug on our webinar, Bill, that rentalownerworkshop.com. You, Doug, and I have done workshops in front of people for many, many years. Because of COVID, we actually created a webinar. And again, the webinar is rentalownerworkshop.com, rentalownerworkshop.com. Doug is our moderator. And Doug, maybe you can talk a little bit about how we actually take one of your clients' case study and walk through their options. And the best thing people can do if they own property right now is to be educated. And Bug, maybe talk a little bit about how we take that case study. And again, any of our listeners right now, or viewers, I keep thinking listeners, can actually go to rentalownerworkshop.com. And we are live, or generally recorded every Saturday in San Diego, but also they can plug it and watch it at their leisure. Maybe we can end on at least a better education for people getting educated on whatever their choices are.
Aubrey, it's hard to break that habit of 25 years on Kogo Radio, speaking with listeners, now having to speak to viewers. But yeah, we've been providing these workshops together as a team for the last 3 or 4 years. And of course, when the pandemic hit, we had to go virtual, and it's been really, really successful. We've created an hour-long webinar that essentially walks a independent rental property owner, a case study, clients that are here in San Diego County that own a small rental property, a small apartment building. And we really just kind of go through the options, okay, similar to what we did today, but really more detailed, obviously. We talk about what it will look like if you pay the tax. Bill does an incredible presentation on the 1031 exchange, which you missed out on today, but if you go to the webinar, you can see that presentation. We also offer a giveaway, which is Bill's booklet, A Guide to 1031 Exchanges. So if you want a copy of this, Aubrey has his. I have mine. You see, I have notes in it and everything right next to me. So when those clients ask, and then we go through the passive and the active options, and we talk about the charitable trust. So really, it's a more detailed version of what we covered today, but it's an hour long. You can watch it at your convenience. It's free to register. And we've got really great feedback because, there's a lot of information out there. Gosh, when you go on YouTube, you get the variety of the total amateur that's making stuff up as they go along, all the way to the professionals, and who knows what to believe. But here we have really the guy who wrote the book on 1031 exchanges. And then Aubrey, you and I do a pretty good job of discussing the options. And quite candidly, it's worked out great. We have delighted clients. We have a lot of success stories that we're even going through right now on helping folks that are looking to get out of the active management, the terrible T's, and get into those terrific T's, time and tranquility, and some travel.
Perfect. I love it. And actually, one of the comments that Aubrey made kind of triggered a thought. He was discussing the tax policy changes. And, so the proposed changes at this point in time, which are probably going to change, we have a long way to go in terms of negotiating and lobbying and all that fun stuff. But today, the investor can defer up to $500,000 in taxable gain for a single person, $1 million for a married person. And so that will be effective January 1st, 2022, if it goes through as it is. We still think it's not going to be part of the bill, but if it does, that could be how it ends up. It all depends on what happens between now and the end of the year. We'll probably know more in the next 30 to 60 days and when we get to see what's actually in the bill. And then, of course, there's still more lobbying to be done. But when you're looking at your current real estate and trying to decide whether you're going to sell or maybe you've already sold, one option is to do a 1031 exchange or a 1033 exchange and split into multiple properties. And the DST could be a great way to do that as well, so that you can split your gain or allocate your gain among a different assets, so that if that proposal does go through as is and is not changed or removed, then at least in the future, when you sell one of those assets, your gain will be under the $500,000 or $1 million for a married couple, and allow you to continue to defer that. If you keep it in one asset and your gain is over that $500,000 or $1 million, and it goes through the bill just like it is, then that could be a challenge in the future. So that was my final comment. This was a great overview on options, strategies, replacement property solutions. If you want to drill down deeper on any of those topics we've mentioned, feel free to reach out to any of the three of us or all of us. We can jump on a conference call together and get more detailed information on what really is suitable or appropriate for you. So along that same line, how can listeners get in touch with each of you? And Doug, let's have you go first, give your contact information out.
Sure. Thanks, Bill. The best way to get in touch with me would definitely be go to my website. All my personal contact information is on there. It's www.rentalpropertybroker.com, rentalpropertybroker.com. And I'm physically sitting in San Diego County. I perform transactions throughout Southern California, sometimes other parts of California, but also I can offer services across the country, because being a part of the Keller Williams real estate network, we are the largest brokerage in the country. KW Commercial is the commercial side of it. But I've been really successful in helping owners find good agents in other markets, especially with your strategy on looking at other markets, maybe buying multiple properties. Part of our services have been helping connect owners that are selling in California or selling their property with other good agents. So rentalpropertybroker.com is the best place to reach me for that.
And I'm glad you mentioned that, because I'm actually selling property in Riverside right now. And it was like, who am I going to talk to? So Doug actually looked up another Keller Williams person, and there was a team up in Riverside, and they have been fantastic. So thank you for that, Doug. That was awesome. And Aubrey, how can listeners get in touch with you?
Doug, I've been in business some 40 some odd years as a certified financial planner. We're completely independent. We don't have a boss. We are the boss, and we provide literally personal financial planning. Probably the best thing to do is go to our website. Real simple, easy to remember. It's moneytalkradio.com, moneytalkradio.com. A lot of information on there, including our webinars, Doug, Bill, that you and I do on a regular basis. Also, we have a little booklet called Are You Financially Organized? Little quick Reader's Digest version of personal financial planning. We look at investments, we look at retirement planning, taxes, estate planning, insurance, sort of a financial doctor, if you will. And our focus in the last 4 or 5 years have been people that own appreciated real estate. And again, the radio show is on Kogo, AM 600 Kogo in San Diego, Saturday mornings at 8 a.m. for 1 hour. Again, the best thing to do is go to moneytalkradio.com. A lot of good contact information in there. Thanks, Bill.
So for the listeners out there, thank you for listening to Go Ahead Ask podcast today. Our next episode, we're going to be traveling to Oregon and doing a little podcast on unraveling the mystery of escrows and the settlement process of selling and buying real estate. We get a lot of investors, a lot of clients who really aren't familiar with what is escrow, how does escrow work, even the same type of questions on title insurance. We'll throw a little bit of title insurance in there. So our guest is going to be George Bosch with Oregon Escrow Services. So if you have questions about escrow, the settlement process, title insurance, etc., join us for our next podcast, and we'll have lots of great information to share there. As always, if you have questions or topics or even want to appear on the Go Ahead Ask podcast, email us at ask@exeterco.com or give us a call at area code 619-239-3091. Thanks for liking us. Thanks for subscribing to us. Make comments. We will respond. Thanks again for listening. See you next time.
Thank you for listening to Go Ahead Ask with the Exeter Group. Join us for our next episode when we further unravel the mysteries of real estate.